Hello, everyone. This is mid-July of 2025, and I've got my old friend Jonathan McGuire. I can't say old friend. He's not old, but I've known you for a long time. I think we started doing a lot of work with you back in probably the late teens. Actually, after 2017 reform, you did the deep dive on the OZ stuff. So Jonathan's with Aldrich, and he's really taken up sort of the lead in that firm with real estate taxation, I believe. And like I said, you really jumped in hard with the OZ stuff. You did a lot of work with Connie Rathbone as a real estate lawyer we do a lot of work with too. I talked to her yesterday. Mm-hmm. It's been a while, and she's all excited about a lot of the changes in the OZ stuff. So really, we've been sitting here waiting for some tax law to change, and Jonathan's also in CCIM with me, a power partner there, and we kept kicking your presentation down the road because nothing was ready.
Right.
And now it's ready.
It's finally here.
Yeah.
Finally here.
And you had a little time off, which was wonderful to hear about, so good for you. And you're ready to hit it hard, and you've got some information to spread. I'm going to actually probably sit here and let you talk a lot, which the audience may appreciate, right? But anyway, it's great to have you here, Jonathan. And I guess the thing that we were talking about briefly at the beginning is I think good tax people are some of the most important people in an investor's life these days, because having tax exposure is one thing, actual taxes owed's quite another. And I think when people just want to, obviously if you're just an employee for some firm, you don't have any investments, maybe TurboTax, something like that takes care of you. But if you start looking at other investments and income properties and other things, it really starts getting tricky quick. And there's a lot of sort of hidden opportunities there. And I think just people they don't know what they don't know. So, for tax planning, I really encourage people to get a hold of you, not April 14th. Get a hold of them April 14th. But do some good planning before year's end, before you ever contemplate a sale. Please give your tax people a call. Jonathan, it's hard to fix things after the fact, right? So how often do your clients actually call you up, say, hey, Jonathan, I'm considering a sale on something, and can you tell me what my tax liability is going to be and what opportunities might exist?
I would say it's about 50-50.
Yeah.
50% do, 50% don't. Or if they think about it, they've talked to their attorney, but they failed to talk to their CPA or tax advisor.
Yeah.
And yes, the attorney protects you from the legal stuff. I protect you from being too expensive on your tax bill. And that's where the real money comes in, especially when you have those sales. So
expensive on the tax bill. I think we had to talk about that real quickly because it's sort of interesting. And people, obviously with Equity Advantage and my brother and I put the company together in 1991. And if you look at what we charged at that point, we charged more in 1991 than we do today, which is ludicrous, right? But you start looking at what the cost of an exchange is typically the smallest item on a settlement statement. But people often will look at, from my experience, correct me if I'm wrong, they look at their tax cost, not tax cost, but the tax planning cost, and they don't quite understand that back to my comment, you don't know what you don't know. It's not the exposure, it's what's actually owed. Two totally different things. And to engage somebody like you, given the opportunity to do some planning, it's a different scenario than just inputting stuff into TurboTax and having it spit out something.
Right. Yeah, it's always better to spend that extra $5-10 grand on tax planning for something big, even if it's only a half hour, because that half hour can actually be valued at $100 grand in terms of what it means and what it saves you, because you had that little bit of time to do some tax planning on the front end of the transaction.
So you saved yourself $2,500 for your tax work, but you ended up spending an extra $100 grand that you didn't have to. So think about it, people. Yeah. I really can't stress this enough. If you're serious about working in the investment world, you should be serious about keeping your money yours. And I was doing a presentation yesterday, similar content actually, and we were just talking about, hey, you pay tax on your income. So when you make it, a lot of states you pay tax when you buy things. If it's real estate, you're paying tax the entire time you own it. When you sell it, you're going to pay tax again. And when you die, you pay tax again. So how many times do you want to pay tax on this stuff? And I just, like I said, you guys, it's one of those things where the laws change all the time. At the beginning, I stated where we are date-wise, because it changes. And I think we talked briefly at the very beginning too, before we started filming, just about Section 121, the universal exclusion. You think about that 250 or 500, it got put in place in 1997. I mean, that's woefully inadequate. But you got to work with people who are going to stay on top of it. I know you had a period of time where you were off the grid entirely, and it's probably energizing to get back in and have something like this to talk about. So with that said, tell us what you found out. Tell us what's going on and how we should be working with it.
I've got my computer here just so I can make sure we keep track of everything, because at the end of the day, there's 200 or so pages of that total bill that are tax legislation imposed in the one big beautiful bill, which we'll call OBBBA. So that's the initials everybody's given it. But I think the big thing, just kind of starting on the individual side, the original Trump tax cut in 2017, we had a change in the tax brackets. So we have a top rate of 37%. That was set to expire at the end of 25. That has now been made permanent. So that is the first thing that is there. That is a permanent tax rate. Granted, where the thresholds are for, because it's a progressive tax system, those are going to be indexed for inflation and go up as they historically have. So that's the first big thing. So for most people, you're not going to feel a tax benefit just from that, but it is going to be a lot better than what could have been 26 onward. So that's the first big thing. Another thing on the individual side, just kind of sticking with stuff that's staying the same or has been permanently extended. Mortgage interest limitation for individuals, itemizing. You had a $750,000 mortgage limitation, so the balance of the mortgage, if you go above that, your deductible interest gets reduced. That has been made permanent. There's a permanent elimination of the 2% itemized deductions. So we haven't been able to benefit from those since pre-2018, but what was in there was certain investment advisory expenses, union dues, other things there. Most people never really got to use it. It was really limited in its application. So, but the one big thing, I think, on the individual side is the expansion of the SALT cap. So that's the state and local tax cap on what you can deduct there. Back in the original Trump tax cut, they reduced that all the way down to $10,000. So that was state taxes, sales taxes, real estate taxes. Sitting here in Oregon, for most of us, you pay real estate tax, and guess what? You're already at the limit these days.
So does that apply to, let's say larger personal property items too? Some states like motorhomes or, big boats and stuff like that also.
Yeah. So like if you're up in, Washington, they have the RTA tax that is on their car tabs. That was something that you would also be able to include in that itemized deduction. But what they're doing is, it's not a permanent fix, but it's a temporary fix for tax years 2025 through 2029. We'll have an expanded limit of $40,000, which is supposed to increase by 1% year over year through 2029, and then in 2030 it's supposed to revert back to the 10. So there's a temporary hiatus, I guess, on that 10,000 limitation, which is good for most people. And there's also, but it does come back to bite us in 2030. But, we'll have 2026, we'll have 2028, we'll have 2030 elections. We'll have a chance to fix it.
So Jonathan, there's always talk about, you got to pay your fair share, and the wealthy don't pay enough. And you think about what you said with you were happy with that 37%, but the 37 is just Fed, right? So on top of that, we're still looking at state taxes. We're still looking at, if we're still a healthcare tax on top of that. So at 37, you're still, in a lot of states, you're knocking on 50+%. on normal income tax. And then if you look at, I think the thing that's interesting to me about the SALT stuff, and even my youngest brother was, sort of saying, well, it's not, you live in these high tax states, high property tax states, that SALT cap at 10. And, so once again, we had a situation where anybody that had more, once again, pay your fair share. Well, you're paying way more than your fair share in that situation. Then you just also mentioned, the deductibility limits, and they stopped at that number also. So you start looking at these things, and I wish people, anytime they start talking about paying your fair share, I wish people would just drop a page showing the tax brackets and how progressive they are. And I always jokingly say to people, I say, look, really the only fair, if you really want to be fair, everybody pay their fair share. It should be a flat tax. Everybody should just pay whatever it is on lineal. I mean, how could you argue against that? But, obviously that changes a lot of different things.
Yeah. And with where we are as a society and what we've valued over the period of time, we've voted in to have people create bills for social safety net and all of those things. And not opining whether that's good or bad, but it's in existence and we have it. And, that's also then why we have that progressive income tax rate is, the more you make, the more you're going to pay, because you're also probably benefiting more from said services such as roads and the infrastructure that exists. But then also, we've valued as a society helping those less fortunate, and we've decided to do that through government action rather than, say, private action, as maybe probably
historically.
Yeah. So that's probably been the big shift since the 60s when all of that, when the whole Medicare stuff originally kind of came through.
It's interesting.
Yeah.
So we're primarily talking about the real estate oriented stuff today, but I think it's very important for people to understand, as Jonathan's alluding, that there's lots in this bill you may or may not be in favor of with respect to cuts in other areas of it. But for today's conversation, we're really going to be talking about it in a application base with investments and your income and what's happening there.
Yeah, and that's why I want to start with the individual, just so we set that table, so we know, okay, baseline, where are we at, where do we go, and now, that leads us to our first big thing for real estate, as well as most small businesses, is the permanent extension of the Qualified Business Income Deduction. So for those that don't know, you get a 20% deduction on what we call qualified business income. And that ranges from income from trades or businesses, rental income, etc. So long as it's operated as a trade or business, that's a term of art, that's not defined anywhere in the code, that effectively says, okay, if I make $100,000 from my small business, I get to deduct $20,000 of that as a above the line deduction, but before we calculate our tax.
So you made a comment, a term in art. I like that. I like to say that it seems like in tax law, rarely is a black and white answer on something. It's how you're going to get it done. So once again, I think the value of working with a good tax professional is once again, you don't know what you don't know, and you don't know how to push stuff or where these opportunities might be. So I think it's really important for people to understand that it's not just, you can't just read about it and have it there. You're going to take a position on it.
Yeah. And there are certain phase outs still with based upon the amount of W-2 wages you pay employees, based upon the amount of property that you own, as well as there's limits based upon your overall income at your individual level, based upon the character of that, whether it's ordinary versus capital gains. And so there's all of those things are there. They're unchanged. What the main benefit was that we get that 20% deduction going forward. And on top of that, there's increased phase out limits. So where it previously started, the number's been indexed for inflation since 2018, so it changes every year. But it's been increased more than what it has been. But they've also introduced a new minimum floor. So long as you have $1,000 of business income that is otherwise qualifying for this deduction, the lowest or the minimum deduction you can get is $400. So it's greater than 20%.
Yeah, no kidding.
But it feels like a little bit of a throwaway because it's just $400, but it's still
On 1,000 though, hey?
It's still something. It's still something that saved you for most people, $100 in tax. So it's meaningful.
Definitely. And what's funny, Jonathan, I'll have somebody in here and we'll be talking about exchange and they'll say, well, gee, I think the smallest gain I ever had in a transaction was like $5,000, and our fee, is going to be $1,000 at a time. So you're looking at four different, and you think about what's involved with an exchange, having to buy in these timelines and everything else. And it's like, well, is it really worth it? And this person was a CPA, and she just absolutely no way she was going to pay the tax. And she's like, nope, we're going to make this happen and it was a few $1,000 benefit. Not that she's a great example, but the people, a lot of times, my experience, our clients with the least, it's the most important to, right? And somebody that's got a lot, it's like I had a guy one time. It's like, well, my tax, it's only $800,000. I don't care. I'll just pay it this time. And it's like, really? So yeah, to your point, I mean, when you're talking 1,000 and 400, or 40 versus 20, I mean that's a huge thing for that person.
Yeah. Another thing in here. 163J. So what that's code for the business interest limitation. Okay. So back in the Tax Cuts and Jobs Act 2018, we imposed, or the tax bill imposed a deductibility limit on your business interest. So you were limited to 30% of what we call adjusted taxable income, or ATI for short. ATI, when it first came out, was effectively what we call EBITDA in the accounting space. So earnings before interest, taxes, depreciation, amortization. So in other words, we would take whatever your taxable income was for that specific entity or activity, add back your interest that you've deducted, add back your taxes that you've deducted, add back your depreciation and amortization that you've deducted, figure out what that number is, multiply it by 30%. And if your business interest expense in full was greater than that 30% mark, the excess would be treated as suspended until you had enough ATI in a future year to offset it. In 22-23, I forget the exact date, the depreciation and amortization portions of that expired. It was a temporary add back. So all of a sudden, in 22, you had people getting a whiplash in tax because they couldn't deduct all their interest like they previously had, or they had a substantial limitation on what they could deduct as interest. Now, for real estate folks, there was a way around that. You could elect out of the application of the 163J rules as a qualified real estate enterprise. And in doing so, you end up slowing down your depreciation. So on a commercial property, you're typically a 39-year depreciation timeline. Not a big deal, because then it just adjusts it to 40. Residential, your normal depreciation life is 27 and a half years. Under this election, it converts it to 30. Yeah. But then what do we do with all the other real property that has a lesser life? So like agricultural buildings, so barns, they, if I remember, they have like a 20-year life. Building improvements, they have a 15-year life. If you do this, you potentially lose that 15 or 20-year depreciation life, and it bumps all the way up to 40.
So how did all that impact or work with cost seg?
So you couldn't really do a whole lot. I mean, well, from a cost seg perspective, yes, you could break out the components of the property into their lesser life buckets.
So for you and the audience, cost seg. So if we look at cost seg in the most basic sense, and I got to ask you this. So if you look at cost seg in the most basic sense, we look at a rental house and we've got an allocation dirt to improvements, right? And I always joke with people. I said, who makes that decision on what each is worth. And if you jack up the value of the improvements versus dropping them, you jack them up, you got more depreciation to take. Your clients, I mean, what do you typically lean on in that situation as far as putting the valuations on the dirt versus improvements in that? And that's cost seg in the most basic sense. Cost seg, the way we're talking about it, you're going to take this building and break it up into 100 different components, accelerating the depreciation. So what Jonathan's talking about is definitely impacts both of those. But back to my question. In the rental house, okay, how's the typical person come up with that allocation?
So the primary way to do it is to take your property tax statement that you get from
which
the
is
county.
Always accurate.
Yes, absolutely, 100% accurate, and use their allocation between building value or improvement value compared to the land value, and that ratio between land and improvement value is how you effectively break down the cost between your building and your land. And so that ratio, call it 80-20, 70-30, that's the default method because that's deemed a qualified appraisal. It passes muster with the IRS in the code. However, if you disagree with that, because it's an outrageous thing, because all of a sudden, let's say you're inside of the urban growth boundary, and now the land value has gone way up, and you've got this shack that's sitting on there. Even though the county might say it's 70-30, you may say, well, no, I actually think it's 90-10, 90 to the land, 10% to the building. Now, most cases you want the building
the
to be
opposite,
value.
yes.
But just from an illustration standpoint, I think that if you disagree with that, you can adjust that for income tax purposes. The county's not going to do anything for you generally, but at least from an income tax allocation, that is one way to do it, to do that split between land and building. So.
Well, I was curious how your clients come up with that number, and it's just one of those things where people start looking at return on investment, ROI, and just that simple change makes a huge difference. Like you said, if it's 90-10 dirt to improvements, that's a totally different return than 10-90. And when you're looking at taking that 90% over 27 and a half years with a rental house, I mean, it makes a big difference. So. Anyway, sorry to spin you off that, but okay. I wanted to jump on that while I've got the expert in the room. So, anyway, onward.
Yes. So I think those are the two of the biggest changes. And by the way, that business interest limitation rule is now permanent. It'll be effective for 2025 tax years onward. So 2024, that's last year. It's pre-baked in. It is what it is. So. Couple other things on here that I'll just kind of quickly go over. Excess business loss limits. So if you have greater than $250,000 or $500,000 of business loss, if you're married filing jointly, there's a limit on you can only deduct up to $500,000. The excess is carried over as a net operating loss to be used in a future year. So you can't take all of your loss and offset all this other income that you have over here. So it's, in a way, it's a fix to the alternative minimum tax, but on the front end rather than the back end. And then another thing too is not necessarily for us in the real estate space, but for businesses elsewhere. The R&D, research and development expenses. This has been a really big, important topic in the manufacturing space, is getting that to 100% expensing on qualified costs in the year they're generated. Prior to this, because of the way the Tax Cuts and Jobs Act was written, that provision expired and it reverted to a 5-year amortization of those costs. So all of a sudden, there was this huge whiplash effect for a lot of manufacturers, to where, instead of expensing 100% of their R&D, they could only do 20% in 1 year, or up to 20%, depending upon how the amortization worked for them. Now you can claw all that back, and it's going to be a huge benefit. It's going to incentivize research and development, the creation of the stuff that we love and use today. So that's a big thing. But switching back towards the real estate stuff, first thing is 179. The threshold for 179 has been increased. So right now, or previously, you could take up to, I think it was 1.5 or 2 million of assets and expense them immediately under 179. Now that threshold has been increased to 2.5 million with a phase out that starts at 4 million. So it's a dollar for dollar phase out. So as you have, let's say you put in $5 million of assets into service in that current year, $1 million of what you could do for 179 is reduced. So that's the way that works. That's effective 1/1/25. For most,
And some of this stuff's kicked out a ways, so to have it retroactive to January is pretty nice.
yes, yeah. The on the 179, typically, if you're in a rental environment, you're not going to be able to take advantage of it. But if you own real estate in your business, there are certain provisions that allow you to expense certain things via 179, such as for like a new roof on a commercial building. So there are some benefits, some provisions there for that 179.
So just for the benefit of the audience, so every time you put a buck into something, typically you're looking at either a capital improvement or an expense, right? And so we're just talking about how these things are going to be treated and planning opportunities for those that are in the know.
Right. Yes. And even then, with 179, it hasn't really had a whole lot of teeth the last 5-6 years because we've had close to or at 100% bonus depreciation on assets that have a 20-year life or less. Well, 179 is going to continue to not have teeth because we have 100% bonus permanently on assets with a 20-year life or less. So that's all your personal property. So computer, furniture, fixtures, improvements to commercial spaces, most agricultural buildings, land improvements, those sort of things are all going to be eligible for this 100% bonus depreciation.
So how often do you take on a client or somebody new that what's the government's position on depreciation? And I always sort of try to get people to understand it's not optional. So, I mean, basically, you should have taken it, therefore you did. So how often do you get involved with somebody where they've never done any of this? And now you got to clean it up.
All the time. Because oftentimes people don't know about cost seg. And so I'm like, hey, you could go get this cost seg, do what we call an accounting method change. We file a form. It's Form 3115, 8-page form with some attachments. You calculate this adjustment, and you get to take the entire amount of past depreciation that you otherwise would have had in these prior years and take them all in the current year. The other thing why this is important...
It makes a big difference.
Yes, it's a huge difference. The other thing that's important, and I've seen the opposite effect of this, is there's a code section 1016, which says, I'm forgetting the exact term right now, but you use it or you lose it with depreciation. And if you don't take it, you're still treated as taking it.
That's the point. That's the big one that I don't think people understand. If you got audited and you never took it, you could be on the hook for something you never got the benefit of.
Yes. And that's where recognizing that you have missed something and doing that accounting method change to be like, sorry, we made an error, or hey, we made this assumption, actually we were wrong. Let's fix this and maximize that deduction to today, because otherwise you're not going to get that deduction if you're audited in a future year. And then on top of that, you're still going to have to pay the recapture taxes on that depreciation, even though you didn't get it. Yeah. So it's going to whipsaw you both ways. So it's really important that we keep an eye on that.
But you have people come in that have no idea, and now you just explained you can fix it sometimes, and you can actually go back and make it better
Yes.
too.
Yeah.
So,
Yeah. And when you do that, it's always based upon whatever the tax law was in that particular tax year. So if let's say we have somebody that bought a building in 2018, they never did a cost seg, and here we are sitting in 2025. We do that. We have them do the cost segregation study, and then we can backdate to depreciation beginning in 2018 when they bought it, which we had 100% bonus depreciation. So all that 5, 7, 15-year property that the cost seg breaks out, we can capture all of that and expense it all in the 2025 tax year based upon that accounting method change. So it's great for the taxpayer. It's great for us because we get to help them and show them the value of this, and we can do it a whole lot faster than probably you can on TurboTax, and with a whole lot less stress. But also, it makes the cost seg providers our best friends in the industry. So,
which keep your ear out, because I think I'm going to be dragging the other Jonathan, in for this in the coming weeks too, just to talk about the impact on cost segregation. So I think we'll have Frizzell come in and talk about if I can keep him on point. So sorry, Jonathan. It's just sort of a challenge once in a while with you. Not this Jonathan.
No, I can stay on point. So. Another thing, though, that was not expected in this bill, which is a huge, very big benefit for manufacturing producers, the people in those industries, is there's going to be a special bonus depreciation provision that gives you 100% bonus depreciation on commercial buildings used for the manufacture or production of goods. So service buildings, office buildings, all of that, you don't get a benefit. This is just for those buildings used in manufacturing and production.
Big Pink's a little too fancy to have.
Yeah, Big Pink, the U.S. Bank, that stuff, not going to happen. But, that whole industrial stuff out by the airport, holy cow, let's put all of our manufacturing right here next to the port, so it's cheaper shipping.
So there's you've already talked about a couple different things that were put in place that really encourage development, production, research, all that stuff here in the United States. So this bill has a lot in it to encourage people to do things here.
Mm-hmm. Yeah, and the thing that I like about this manufacturing thing is if tariffs are going to be a thing, and we have unemployment, then heck, let's onshore what we can. We're not going to be able to do everything, but let's onshore what we can, take advantage and create jobs here in the U.S., protect our people here, and here's a way to do that to make it pencil on the front end while you're getting up to speed, because then you're going to be able to say if you're expensing 100% of the building, you're not paying taxes for 5 years. I'm just saying, it's not going to happen.
It's interesting to me to think about like the Jones Act. I mean, with just the maritime world and the impacts that has on so many different things. People don't understand just the oil, the energy. I mean, anything that you're putting on the shipping, cruise ships. I mean, where they go, and where they're built, where they're registered, all of that stuff. With that Jones Act really impacts. I hear there's conversations about some changes in that too, but I think this really is it's interesting because obviously this is the first time I've talked to anybody about these aspects of it, and it's fun to hear, actually.
Yeah.
You start thinking about this country and how it was working during World War II, for example, everything that was built here. You think about Portland, Oregon, the number of ships that were built here.
Yes.
And the whole West Coast. I mean, a good friend of mine, good family friends. I've been blessed to have spent a lot of time with them and actually have some of their product. But the two families own Michelson yachts, and my boat was built in San Diego and by them, by a company called Knight and Carver, that did a lot of work for the military too. Nobody's building boats, down in California or Oregon. I mean, Washington still has some big yards up there doing stuff, but California, basically they killed it with all the taxation, all the different things. So to see things legislatively passed that would encourage these things to be built back here once again, and Michelson, for example, a lot of their yachts are built in Taiwan these days. Well, the tariff thing, I haven't talked to them about it, but I mean, the tariff thing's got to be a big concern at this point.
Yeah, and if the goal is to onshore,
yes,
I mean, what a better provision to do to help incentivize and get that going now, because I think there's two big things that we're lacking on with being able to do that. One is the space to do it, because we haven't been manufacturing, we've been outsourcing it. So here's an opportunity to build the facilities that we need to do the production here in the U.S. The thing that's going to be the tricky component is, okay, where do we go find the labor? Because who's going to do that work? And so I think that aspect, it's a great policy. If your goal is to onshore production, the question is going to be, can we actually employ the people and produce what we need to produce at a competitive price?
There's a period of time between now and robotics.
Yes, true. Which, there is that aspect too, which, as AI and all that stuff kind of comes in, that's going to change some things. But in the short term, can we get there, depending upon what it is and what level of human interaction do we need in those production activities?
Well, it's funny. A few weeks ago, I had somebody in here. We're talking about. Actually, it was one of the DST sponsors, and we were talking about labor. And there was one. I can't remember what state it was. Maybe New England, one of those states back there. They can't even get young people to be lifeguards. It's like there's not a better job in the world for a young person being a lifeguard. I was one. Okay, I mean, and nobody even wants to do that. So okay, yeah. So back to your labor force deal. Yeah, it is a concern. So anyway.
Yeah. So I mean, we'll see what happens. I think it's a step in the right direction. Granted, we've got other things in the bill that are not tax related that other people are having concerns with, which are valid, and I'm not discounting that in any way. But just from a tax only perspective and looking what they're trying to accomplish in this particular policy, I think is well thought out. Yeah. So that's the depreciation world. Then the other big thing, which is near and dear to my heart, is the opportunity zones. This came out in the Trump tax cuts in round one in 2018. Huge compliment to what 1031 exchanges do. By the way, 1031 exchanges have not been touched in this bill. So you still have a job.
For once.
You still have a
Yes.
job. So
And 17, but we were talking about it earlier. 17, we used to do lots of high-end cars and lots of corporate jets and helicopters. Hillsborough Aviation, #1 Bell dealer in the country at that time. We used to do all their stuff and a lot of collector cars too. It was so much fun to do that stuff. And that all went to the wayside with the OZ stuff. So I got to say, when it first came into play, I wasn't really very happy about some of this stuff. But I think if you look at overall the impact, I mean, there's been some projects that really exemplify the wrong end of it, but there's some incredible projects that have gotten done. If you just look at what Barry did on the Vancouver waterfront, that project alone just totally changed. I mean, it did exactly what it was supposed to do.
the entire Vancouver waterfront is beautiful.
Yes.
And the Ritz should have never been an OZ deal, but we won't talk about that one. Yeah. But with this new bill in OBBBA, OZs have been made permanent. So previously they were supposed to end at the end of 26, and it was going to be a one-time program. it looks like the opinion of Congress is it's working. It's doing what it was intended to. It took a little while to get off the ground, and then COVID kind of put a pause on it.
Yes.
For a little bit.
And I think just real quick, some of the sort of the initial issues probably were created by, it was, correct me if I'm wrong, the governors in each state were picking the zones, and that some of the data was back to what, 2010 census
Yes.
or something like that.
Yes.
So you had areas, you joked sort of about the Ritz, but you start looking at, okay, where should development be? Vancouver waterfront was one of those places where, yeah, clearly it needed help, and it's just changed everything. The Pearl, on the other hand, I don't think
it was already going.
Yeah, the Pearl wasn't a place that needed some economic stimulus. I mean, you look at some of the areas in Bend too versus, Redmond or Prineville or other places. So, and you're going to talk about rural, some changes there too. So, I'll get out of the way and let you talk, but I just think you got to understand why this thing was originally put in place, and it was there to stimulate development areas that needed development and for the greater good. And I've seen some incredible projects, and so now we were dealing with a sort of a factor where everything, the real benefits were going away because some things were sunsetting, and now you say they're permanent, and not only are they permanent, we've got some other much even better opportunities there.
Yes. So with the existing OZ program, so everything that was passed and put in place in 2018, those rules continue through 2026, and those zones also continue through 2028. The way the bill was written is in the year that a zone is designated, whatever, let's say it's 2018, it was the year all the zones were designated, January 1 of the following year starts a 10-year clock. So you have until January 1, 2019 through December 31, 2028. That's when those zones expire. Okay. In this new one, and what they're going to do is what they call a decennial election or designation date. And so every 20x6 year, so every 6th year of the decade, they are going to designate new zones based upon the census data and whatever criteria that they have in this bill. It's lots of words, lots of pages, and I'm not going to go into it. And we're beholden to whatever the governors and Treasury certify. So we have no control over that. But to that end, as those are designated, then those zones will run from the January 1 of year 7 through the end of year 6 the following decade. So you have a 10-year run. So that's how the zones are going to be designated. With that, it's going to become a rolling deferral program. So now you're going to have a 5-year deferral. So previously, whenever you invest, you have until the end of 2026. Now it's whatever date I invest, 5 years in the future is when my deferral period ends. Previously, there was a basis step-up provision. So once you held your OZ investment for 5 years, you'd get a 10% basis step-up. After 7 years of holding it, you'd get a 15% basis step-up, depending upon there's certain criteria there. Now, this rolling program is going to give you, after 5 years of just investment period, you're going to get a 10% basis step up after 5 years. If you have to divest in year 3 or year 4, you get a prorated portion of that. Now, one thing I haven't talked about, but you hinted at, was rural opportunity zones. There's going to be a new form of opportunity zone, and there's a certain number of zones in every state that are going to need to be rural designated zones. And there's increased incentivized benefits to doing these certain rural zones. And with that is when you hit that 5-year mark of investment, instead of a 10% basis step up in your deferred capital gain, you can get a 30% step up in your deferred capital gain. So that's meaningful.
A big benefit.
That is huge.
Yeah.
the 5-year deferral, though, or excuse me, with the rural zone, for what designates it as such is it's got to be a metropolitan area under 50,000 people, or for whatever that census tract is located inside of. So if we're in Portland, obviously not going to work. If you're out in Prineville and that's designated as a zone, it's going to be deemed rural. So that's kind of, just think urban.
So, I mean, yeah, I mean, really, it's going to do a great job of stimulating development in those areas. I mean, and decentralize it all in the urban centers. I mean, it'd be a great thing, I think. So,
Right. Yeah, and it's because a lot of the money that came in to OZ did do stuff in urban areas. So like Vancouver waterfront, downtown Portland, downtown Salem. I
I toured a couple projects up in Olympia that a good friend Greg Genovese put together, and yeah, beautiful projects. And I mean, his project up there is right adjacent to the UW campus there, and so it makes it's neat to see.
Yeah. And so the added benefit, though, for the rural zones is previously, if you bought a pre-existing structure in the OZ rules, whatever your basis was, your purchase price that was allocated to the cost of the building, you would have to do improvements in that building that equaled 100% of the basis. So if it cost you $1 million, you have to put $1 million of improvements into it within a 30-month timeline. In this new rural designation, you only have to do 50%. So if you buy $1 million structure, you only have to put $500,000 of improvements into it. So it's going to be a lot easier to complete and do something in a rural zone, because it's also going to be harder to do a project there and make it pencil. And so they've recognized that. They have that data because the amount of activity is disproportionate to urban versus rural areas. And so they want to drive more rural economic development, because that's where a lot of the poverty is.
So Jonathan, I think it's important for people to understand, because I have people asking all the time, say, okay, so I bought a piece of property in the zone, so I get all that benefit. That's not the case. You've got to actually put the project together. The scope of that is plan just for people out there to understand. I mean, is that a several month process typically, or what's sort of involved with that? I know you've been involved with
it. Depending upon where you're doing it and whatever city or county you're working with, you can go really fast on your development. Or you can take 18 months just to pull a permit. So
we're probably living in this area that's going to take 18 months to get the permit.
Yes, but to that end, I mean, you have a very nice runway to get projects done, because they have what's called the working capital safe harbor, which allows you to hold on to cash and cash equivalents that are to be used and expended within a 2.5-year period of receipt by the fund, or not the fund, but the Qualified Opportunity Zone business. We'll let Connie talk about the two-entity structure, but to that end, you've got a healthy timeline, a healthy run on being able not only to acquire what you need to do, but to actually construct what you need to do in the underlying improvements. So it can take 3-4 years to get something done, but it allows you the time to do it right at the right cost. You just got to take action.
So just for an application comment, and we are running short on time, so I won't take much, but I as far as the OZ stuff, I think it's a great end game for people. Obviously, if they're selling a business or something, it's one of the ways to really mitigate some of the tax exposure. Selling until they do something with a 250 or 500, even a high dollar home, you can mitigate some of the tax consequences. If you're looking at a sale of a home and you've got gains well in excess of 250 or 500, you can employ the OZ to take care of some of the issues there. It can also be a fallback for a 1031 that was not completed. The issue is you've got 180 days from disposition to make this happen. If you're in an exchange, 1031 G6 prohibits my release of funds to the taxpayer within that 180-day timeline. So I think it's important for people to understand what's happened. And so with that said, really you're talking about as far as the investment in this, you're not having to invest all the proceeds or all the
Right.
value. You're
Right.
just looking at investing the gain.
Just the gain. And if you need to go get a short-term personal loan or some hard money or something,
So
you can
if
do that.
if you're working with me, what Jonathan's saying, so you're working with me, 1031 G6 ties my hands. I cannot give money back to my clients until they've purchased everything they have the right to buy. So I really caution people, don't ID things that you're not sure you're going to buy on the 45th day. If you've ID'd something you're not sure you're going to buy it, rescind the ID, I can give you the money. Otherwise, you're looking at a transaction where I've got your money and the 180 days, you've got 180 till I can release the money, 181, and you got 180 to make the investment. As Jonathan just said, I just want to clarify this. As Jonathan just mentioned, the money doesn't have to be the proceeds from the sale that I've got. You can go get a loan someplace if you're in maybe your retirement account, 60-day rollover, something like that. But get access to the money. You're just talking about the money representing the gain on that thing. Get it into the OZ, and that you're going to have some tax relief, though. So I think it's really important. Once again, don't call Jonathan April 14th. Well, call him 14th, but call them for planning when you're contemplating a sale or when you're in the deal, or at least before year's end, to look at what's going on.
Yeah.
So,
yeah. And one last thing on the OZ that ties in with this depreciation stuff, which I think is just naturally the holy grail of tax planning opportunities. If you want to go start a new manufacturing or production business, you put it in a rural opportunity zone, you bring those investors in, they're going to get a 30% basis step up on their deferred gain. They're going to get 100% bonus depreciation on their building because it's used in the production activity. And then after 10 years or more, when you're done with this thing and you go to sell it, you get 100% basis step up in your investment, which includes eliminating the depreciation recapture on the building. So the only thing that you don't get a benefit from is the land, because you're never going to get benefit from the land.
So you industrial real estate brokers and development people, give Jonathan a
This
call.
is going to be really big,
Yeah.
26 through 29.
Wow. Thank you for that little nugget. That's a big nugget. Yeah.
So we'll see what happens. Got to wait to see what the new zones are.
Yeah,
So,
no kidding.
next year. So
Well, it'll happen. It'll happen. So what else do you have for the good of the order here, as we'd say in Rotary?
I would say no tax on tips and deduction for overtime pay.
So suddenly nobody in my firm gets anything but tips, right? I mean, I just look at some of these things like it's ripe for fraud. I mean, everybody's working overtime.
There's a
mean-
lot of provisions,
Yes.
and limitations on it, but it's a great campaign promise that technically is fulfilled
Yes.
based upon the passage of the bill. There's not a whole lot of teeth in them, but for those individuals in those lower to lower middle class earners, where tips are a big part of their livelihood, it's actually going to be meaningful for them. Also, those that are your hourly workers, that's going to be another thing that there's a threshold. I think it's like 25 grand of overtime pay you can take advantage of. Or there's some rules in there, but I haven't paid a whole lot of attention to it, just simply because it's not the clientele I work with in the real estate space.
So with that said, I always enjoy my time with you, and I know we've got you scheduled for CCIM coming up soon, and we'll probably have to revisit the OZ stuff again, just so people are more clear on the application of that, because I think it's a good opportunity. And it's not, people sort of come to me once in a while and say, well, gee, why do you have OZ stuff there? That doesn't really help you. So we just want our investors to understand what's out there, so we try to get people like you in to talk, and I get to learn too. So on the big thing, I get to learn from all you guys. But I think that you've done a great job of explaining some of the key issues that we're looking at. And once again, today's talk was not aimed at the whole bill. We're just talking about the tax issues that are, beneficial to our people, and we want our clientele to understand that. But with that said, people know how to get a hold of me, Jonathan. Obviously you do take on new clients. If somebody were to reach out, they want to get a hold of you, what's the best way to do that, and sort of what kind of clients do you typically take on?
Yeah, the best way to get a hold of me is just go to our website, aldrichadvisors.com, through there, or just Google my name. I'll probably pop up really quick, just my name, CPA. You'll
Or
probably
QOZ,
find me.
it probably comes up that way too, probably.
Those are things that'll help find me. In terms of what I'm looking to take on, we work with developers and investors, preferably on the investor side, syndicated level investors. On the developer side, anywhere from Joe Blow up to the big, high and mighty fund sponsors. That at the end of the day, their tax issues at a real estate fund level, large or small, are the exact same. It's just you throw a couple zeros behind it, and
And Aldrich, you guys have a few locations too. I know you've got one down in San Diego. You've got where else?
Up and down the West Coast. So we're in new office, Spokane. We acquired a firm out there. We're Lake Oswego, Salem, and then going down Southern California. We're in Brea, Orange County, Carlsbad, and Mission Valley, San Diego. Right. And then we also have 2 offices in India that are our employees.
Really?
So it's not just an outsourced thing. No, they are our employees that we were able to use, and so when we sleep, they keep the work going for us. So which is great.
No wonder you got the sabbatical.
and then also we're in Salt Lake and Denver now as well. So
great. Well, thank you so much for being here today. Really enjoyed it, and I look forward to hearing you at CSIM. And obviously, it's always fun to work with you. So thank you today.
Yeah, thank you.
David Moore, Equity Advantage, 1031exchange.com, and thank you for joining us today. Bye-bye.